Okay, I think we can get started. So welcome everybody. I'm glad you were all able to make it today. We are having our semi-annual CPE provider forum today. And for those of you that don't know me, I'm a project manager at the FASB. And again, just want to thank you all for your interest and participation today. So first, I just wanted to start off introducing our presenters today who will be with us throughout the forum to assist with questions. And I will start with Sue Cosper. So Sue, if you want to introduce yourself.
Hi, Liz, thanks. I'm Sue Cosper. I'm a board member, been at the FASB on the board since 2019. And prior to that, I was the technical director.
Thanks, Sue. Nellie?
Hi, everyone. I'm Nellie Debler. I'm the Deputy Technical Director. I joined the FASB in May. And prior to that, I worked in an advisory practice in a big accounting firm and was a PTA.
Thanks. Jeff?
Sorry about that. Just took me a while to unmute. I'm Jeff Mechanic. I am an Assistant Technical Director at the FASB, where I oversee all activities having to do with private companies and not-for-profit organizations. I know stakeholders that you guys are very interested in. Great to be with you here today again.
Thanks, Jeff. And Bobby?
Hi, I'm Bobby Gwynn. I'm a project manager at the FASB. I've been here for about 2.5 years. I work primarily on revenue and leases related activities.
Thanks. So just a couple housekeeping items. So the forum is intended to allow CPE providers an opportunity to inquire about final and proposed accounting standards with board members and FASB staff with the goal of assisting in your preparation of accounting and reporting courses. As a reminder, the forum is open to standalone CPE providers whose primary business is to provide CPE, as well as individuals who provide CPE within their organization, so such as a CPA firm or to their organization's clients. The slide presentation is available for your viewing during the webcast. It is in the chat, and it's also downloaded on our FASB website under the Educational Webcasts and Webinars tab. So for each topic, the project's teams will spend a brief portion of the allotted time presenting and an update of the overview of the project. And if you have any questions on those topics, we will be spending that time. If you want to ask them during the time the project is being presented, that would probably be best. We do have some time at the end if we don't capture everything. We encourage you to ask questions, and we plan to be flexible with the agenda depending on how many questions we get. Feel free to submit questions ongoing throughout the forum. You can submit questions using the Q&A feature, not the chat feature on the bottom of the screen. We'll try our best to do answer all our questions. However, we may not be able to get to them all. And feel free to reach out to the individual teams for further follow-up or additional questions. And the views discussed today are based on the individual speaking, not necessarily representative of all the views from all FASB members. So just getting into the agenda for today, we're going to first talk about current hot topics, implementation of new standards, and recently issued ASUs. We will then have a brief discussion on current projects and finish with any remaining Q&A. So before we begin, we will be sending out, yes, so the slides, I did mention this earlier, but again, just if you're not aware, you can look at them through the chat. We did put a link to the slides there, but also on the webpage, the FASB webpage where we have educational webinars. We will be sending out a survey after today's session to get feedback for future CPE provider forums. You know, if it is of interest to have more of an interactive dialogue between CPE providers and the FASB board and staff, we'd be very happy if someone from you, if you or someone from your organization would be interested in being an active participant, just let us know, and we can think about it in the future if we have enough interest. A link to the archived webcast will be sent out after the forum and will be available for about 6 months. So we will move on to our next topic now, which is, first, we're going to talk a little bit about FASB response to COVID-19. So we can go on to the next slide, slide 9, I think it is. So This is now, the second year since the beginning of the pandemic, and the FASB continues to allocate staff resources to focus and respond to stakeholder questions as a result of the pandemic. The board has continued with regular board meetings and has made progress in some of the active agenda projects. That said, the FASBs remain responsive and continue to monitor questions that come up. And we are committed to assist stakeholders on an ongoing basis. The webpage is focused on the FASB's response to managing the COVID-19 accounting issues. In addition to the link on the slide, the FASB's homepage, there is a button on the right-hand corner that is a quick link that will bring you to the COVID-19 webpage. And you can get a quick link to various accounting resources such as Q&A documents, such as on hedge accounting or accounting for lease concessions, an educational document to assist in applying accounting guidance on debt modifications or in troubled debt restructuring, a link to the FASB's technical inquiry service where people can send us questions, a link to the FASB's implementation portal, which is a one-stop shop for implementation issues that have arisen as a result of the COVID-19 pandemic. So we'll just move on to debt concessions, the next slide 10. And we did discuss this a little bit on the last CPE provider forum, so I'm not going to go into as much detail as I did last time, but the first notable event that's been occurring because of the effects of COVID-19 is the increase in modifications or exchange of outstanding debt arrangements. The FASB staff understands that many entities have not previously applied the guidance on debt modifications and extinguishments and troubled debt restructuring. In response to a request by the Private Company Council, the FASB staff developed educational materials to provide stakeholders with a summary and overview of the application of the appropriate guidance. That educational document also includes several illustrative examples of common debt modifications and exchanges. So, for example, modifications to debt arrangements may include any of the following: a reduced interest rate for the remaining debt term, an extension of the maturity date at a stated interest rate lower than the current market rate for new debt with similar risk, a reduction of the face amount or maturity amount of the debt, or a reduction of the accrued but unpaid interest. Whenever there is a change to the contractual cash flows of a debt arrangement and the debt remains with the same lender, borrowers will need to first consider the troubled debt restructuring guidance in subtopic 47060, and if the change is not concluded to be a troubled debt restructuring, consider the debt modification guidance in subtopic 74050. Those debt modifications or concessions can result in several different outcomes from an accounting perspective. The borrower is experiencing financial difficulties and is provided a concession by its lender that it would not otherwise occur. The original and the new debt instrument are not substantially different, or there is an exchange of debt with the current lender for a new arrangement with substantially different terms. The nature and extent of a debt modification will determine the accounting effects on an entity's statement of operations and statement of financial position, which I will cover shortly. So on the next slide, this diagram illustrates the accounting treatment for debt modifications and exchanges. And as you can see, if the borrower is experiencing financial difficulty and the lender granted a concession, in accordance with subtopic 47060, the borrower would apply the troubled debt restructuring guidance. If the borrower is not experiencing financial difficulty, or if the borrower is experiencing financial difficulty but no concession is granted, then the borrower should apply the guidance on debt modifications and extinguishment in subtopic 74050. On the next slide, I will continue to talk about borrower considerations. So I'm not going to go into too much detail here, but first you have to consider the troubled debt restructuring guidance. The lenders, there are factors in GAAP that a company's management must evaluate to determine whether the borrower is experiencing financial difficulties and also whether the lender is granted a concession. Ultimately, the accounting for a troubled debt restructuring that involves modifications to the terms of a debt arrangement depends on whether the total undiscounted future cash payments, as specified in the new terms, are greater than or less than the carrying amount of the debt at the time of the restructuring. If future cash payments are less than the carrying value of the original debt, a gain is recorded for the difference. And if future cash payments are greater than the carrying value of the original debt, no gain is recorded. If a borrower has concluded that the change to their debt arrangement is not a troubled debt restructuring, you must then assess whether there is a substantial difference in cash flows to determine whether the new arrangement is a continuation or an extinguishment of the existing arrangement. So with that, I will now turn it over to Jeff Mechanic, who's going to discuss impairment of non-financial assets.
Thank you, Liz. And again, great to be with all of you here today. So this is another topic, impairment of non-financial assets, that's been discussed by the board and staff at various private company council meetings, PCC meetings, and highlighted on various webcasts. And indeed, this slide has a reminder that there are various models that come into play here within GAAP. And it's a handy summary that you may have seen in some prior webcasts. And as a reminder, there are essentially three models. One model applies to goodwill. Another model applies to other indefinite-lived intangible assets, and a third model applies to assets that are tested as part of asset groups, basically fixed assets and finite-lived intangible assets. Let's move on to the next slide, which homes in on the timing requirements for that impairment testing. So as a reminder, the testing for goodwill is annually. We'll get to a private company alternative in a minute. Or whenever a trigger exists. And you'll often see the term triggering events, but really what we're talking about there are triggering events and circumstances, things that either happen suddenly or happen gradually over a period of time that may lead to the potential impairment of goodwill. Same thing with indefinite-lived intangibles. They are tested annually or whenever a triggering events or circumstances exist. And then finally, asset groups, long-lived assets and so forth, they only have a trigger-based impairment test. And so let's move on to the next slide. And that is a reminder here that with ASU 2014-02 for private companies, and then ultimately ASU 2019-06 for not-for-profits, those two groups of stakeholders have the option, the alternative, to amortize goodwill, and as part of that, to only do impairment testing upon the occurrence of triggering events and circumstances, rather than having to do an annual impairment test. Let's move on to the next slide. And it's with that regard, with regard to triggering events and circumstances, and everything that was going on last year with the pandemic and all the uncertainties and some gradual, some seemingly month-to-month significant changes in circumstances and thoughts and around uncertainties and so forth, including in some cases, some things that got better going from the spring to the summer and then into the fall. Anyway, all of that is those circumstances with regard to this trigger-based testing, whether or not it's coupled with annual testing, is why the Private Company Council and the AICPA Technical Issues Committee, or TIC, raised questions about this area, about perhaps undue cost and complexity. And as a reminder here, with trigger-based testing, what you're supposed to do is you're supposed to perform the impairment test using the date of the triggering event or circumstances as the measurement date, and somehow do so without the use of hindsight or any known changes to facts and circumstances after the measurement date. That's prohibited. So imagine you're a private company or a not-for-profit for that matter that reports only once a year, but you're doing your annual report perhaps months after there was some sort of change in circumstances, and you are supposed to at the end of the year, months later, think about the circumstances that existed as of the date that you hypothetically would have identified a triggering event, the possible diminishment of goodwill, and do an assessment as of that date, looking back, but somehow not using hindsight about what things have occurred since then. So in thinking about doing this, and again, this has always been the case, but it was just heightened by the magnitude of the uncertainties and changing circumstances last year. The PCC and the TIC indicated there were lots of practical difficulties here, especially for companies and organizations that were reporting only once a year as opposed to quarterly. And some would argue, including some of the PCC members and TIC members, that when you are reporting ultimately at an annual or quarterly basis, that may not be the most useful information to try to talk, to base your impairment analysis on things that may have existed months ago, but may have changed since then. So for both of those reasons, the FASB considered this. Let's move on to the next slide, and ultimately issued ASU 2021-03. And what that does is it provides private companies and not-for-profit organizations the option, the alternative, to, instead of doing the impairment testing as of this trigger date or whatever, to perform its goodwill impairment evaluation as of the end of the reporting period. And depending on whether the organization or company is reporting GAAP financial statements on a quarterly basis or on an annual basis, it would be as of that date. So for example, if you thought that the triggering events were occurring sometime in March and you reported at the end of you only reported annually, then you'd be talking about doing your assessment at the end of your annual period, which might be in June, it might be in December, depending on the year end. If you report on a GAAP basis on a quarterly basis, then you would be doing it at the end of the next, the next quarter end. So this is something that again, all private companies, not-for-profits have the option. It's definitely we think will both be more cost-effective and arguably produce maybe even more useful information. We are currently in our broader goodwill project, which I'll be talking about later, evaluating currently whether to extend this to public companies. This is effective for fiscal years beginning after December 15, 2019, in other words, for calendar year 2020 or fiscal 21. But early adoption is permitted, and we have heard of companies and organizations early adopting this. Let's move on to the next slide. Actually, before we do that, let me answer a question that came in that we received prior to the webcast. I think it's a good time to do that. So ASU 2021-03 allows an election of an accounting alternative for goodwill impairment testing of event evaluation to be performed only as of the end of each reporting period. And performing the evaluation is management required to consider triggering events that occurred at any time during the reporting period, or only those that are applicable on the evaluation date. It's my understanding that it would be the conditions, the circumstances as of the reporting date. So I think that, again, is one of the major advantages of this ASU, is not having to monitor continually during the period, but just monitor where things stand at the end of the period and base your impairment assessment using those facts and circumstances. So let's move on to another area, which is the COVID-related federal assistance. And we've discussed this at some length in past webcasts, including the March CPE Provider Forum. So my plan here is to briefly review this and really focus more on updating you on any developments since the March forum. So the first program I'm going to mention is the Paycheck Protection Program, the PPP. Many of you are very familiar with this program. And as a reminder, the AICPA issued some technical questions and answers, TQAs, back in August of 2020. They actually did some TQAs from a lender perspective, and then from the borrower perspective. I'm going to focus here on the borrower perspective. And those TQAs, as a reminder, indicated that there were two possible approaches that could be followed here for not-for-profit organizations. We'll get to business entities in a minute. One was a loan model, and that would be usable regardless of whether the organization was seeking forgiveness. But if the organization was seeking forgiveness, another possible model is also available, and that is the conditional grant model under subtopic 958-605. There are some key differences in these models, both in terms of the nature of the liability and possibly the timing of any revenue or gain recognition. The TQAs talked about these two models. If you do end up in the conditional grant model, there are all sorts of other judgmental areas having to do with the nature of any barriers to entitlement when they're met, and in particular, whether the review or forgiveness process, the loan review or forgiveness process, is a separate barrier to entitlement. Moving on to business enterprises, the TQAs indicate, next slide, please, that there's also a couple of other possible models there. Instead of the government grant model under subtopic 958-605, if they're seeking forgiveness, they could use the government assistance model under IAS 20, a somewhat different model, and I'll talk about that briefly in a minute. And then one other possible model is the gain contingency model, which we haven't heard of too many folks using, but that's out there as well. An important point to note here is that there is not direct on-point guidance with regard to receiving government grants or things that could be treated as government grants within US GAAP for business enterprises. So, but also very importantly, while they are scoped out of that, at least the not-for-profit model, they are not precluded from analogizing to that. And so they could analogize to that model, or they could alternatively, since there's not on-point GAAP there, if they want to use a grant model, they can use the IAS 20 model or a gain contingency model. Let's move on to the next slide, which has a little bit more information about these models. I think the key thing I'd want to point out, not only for the PPP, but for when we get to some of the other assistants that use a grant model. If they use the IAS 20 model, they have the choice of either recognizing revenue or gain gross, or they have the instead netting it against the related expenses for which these are reimbursement. Again, that's not that netting alternative is not a possibility under the government, under the grant model under subtopic 958-605. As I mentioned, we haven't heard much about the gain contingency model being used for the PPP. Let's move on to the healthcare provider relief funds. As a reminder here, the AICPA put out some TQAs last fall. I think it was in September of 2020, but they also revised that guidance or some aspects of that guidance in April of 2021. And the link here is to the updated version of the TQAs. One of the challenges with those doing the TQAs is that the guidance from the Department of Health and Human Services has changed a bit over the months, and that's been at times a little bit of a struggle to keep up with. But as a reminder, the monies that have come through the Provider Relief Fund are primarily grants, and you'd be following one of those models, either the 958-605 model if you're a not-for-profit, or if you're a business enterprise, you could use that model, or the IAS 20 model, or conceivably a gain contingency model. But there is a portion of the provider relief funds that are not grants per se. You wouldn't be using one of those models. There are monies under the provider relief fund that are reimbursements for treating uninsured COVID-19 patients. And what that actually allows you to do, allows a healthcare provider to do, is to recognize some revenue under topic 606, exchange revenue, patient service revenue, that they otherwise would have written off to charity care or implicit price concessions. But now, because of that reimbursement, they'd be recognizing additional revenue, and here now third-party payments against that additional revenue. So it's a little bit of a difference from much of the rest of the provider relief funds, which would be pure grants, but again, so it's a mix of those two. I do want to also point out that the AICPA is currently drafting some TQAs. We've seen a draft of those, and I expect them to issue these, I hope sometime within the next month, that deal with the accounting for vaccines that are being distributed and administered through healthcare providers. Okay, so again, just want to call your attention to that. Keep on the lookout for that TQA when it's released. Again, we think within the next month. Let's move on to the higher education emergency relief funds. We talked about this a bit during the March provider forum. I want to remind you here that there have been some tutorials that have been issued. We looked at these before they were issued by the National Association of College and University Business Officers, NACUBO. They can be found on that website and definitely accessible by those who are members of NACUBO. But I just wanted to remind you there that there's been 3 tranches of these higher education emergency relief funds. One stemming from the CARES Act, from the Reconciliation and Relief Act, which was back in December, and the American Rescue Plan Act in March. They have some slight nuanced differences to them, and the tutorials go into that. But the key thing to note here is that there are two pieces to each of those tranches. There is a student aid piece and a piece to reimburse the institution, the university, for lost revenues and out-of-pocket expenses. And really where the potential differences in views concerning the accounting is whether or not to link the timing of the revenue recognition for the institutional portion to the timing of giving out of student aid grants. There's a couple of views there, a linked view and an unlinked view, and then the Kubo tutorials go into that. Let's move on to the next slide. So besides the ones that, all these that I've already mentioned, which we reviewed during the March CPE provider forum, there's a couple of other programs that we've been getting some questions about and where the AICP has put out some guidance. First, there are employee retention credits. That's a refundable payroll tax credit, as many of you know, that's designed to encourage employers to keep employees on the payroll, with certain qualifications that the ERCs are subject to. They were included in the original CARES Act, as well as the Consolidated Appropriations Act and the American Rescue Plan Act. But very importantly, there was originally some confusion that was clarified in the Consolidated Appropriations Act in December as to whether a company or organization could receive both PPP and employee retention credits. The December Act did clarify that indeed an organization or company could, as long as they didn't double dip, as long as they didn't try to claim the same expenses under both programs. But many organizations, many companies didn't find out about that until their 2020 fiscal year end had closed. So there were some questions about what to do, how do you account for that? I won't, we haven't addressed that at the FASB, but I will say that the Center for Plain English Accounting of the AICPA, which many of you may belong to, has addressed that in one of their papers, and they, I think, if I remember right, recommended some sort of loss recovery model for situations where you received this back in 2020, but you've already reported out on your financials for 2020. Going forward, we believe that that in many ways this is again like the PPP, but it's not formally alone. So really, all those different grant models that we were talking about under the PPP, one specific model for not-for-profits, a couple different models for business entities, would be the types of things that you might look to account for the employee retention credits. And then finally, some of you may have been hearing about the Shuttered Venue Operators Grant, as well as the Restaurant Revitalization Fund grants. And the AICPA just issued recently, I think about a month ago, some TQAs here, again, following grant type accounting. And again, the link is right here. I do want to point out here that while the Restaurant Revitalization Fund grant probably mainly is going to apply to business entities, I suppose there could be some not-for-profits that fall under that. The Shuttered Venue Operators Grant would apply to lots of not-for-profits. Think about, for example, those performing arts centers and lots of others who had to close their doors to the public, during the pandemic. So look to those. Be aware of it. Just be aware that the AICPA has issued some TQAs here. And then finally, moving on to the last slide in this section. I mean, what we have here, as you can see, is lots of programs, lots of judgments involved, especially on the PPP, but in some other areas as well, and even some different models, especially again with the PPP. So what's really important here is good disclosure. There's always been this requirement in GAAP to disclose significant accounting policies when you have a choice of accounting policies. So think about the different ways in which you might treat the PPP or some other types of grants, especially if you're a business enterprise and you don't have on-point GAAP and you're analogizing to one model or another. Anyway, there's some good disclosures there. But as Liz is going to tell you about in a minute, we are just finalizing an ASU, which in many ways is based on some best practices that we're hearing about in this area, or is consistent with that, that I think we can use, that will be very beneficial when you report on the current year and subsequent years. And with that, I'm going to turn it back to Liz, who's going to talk about that soon-to-be ASU.
Thanks, Jeff. So I'm going to be talking about the project on disclosures for government assistance for business entities. And we can move to the first slide about the timeline. So here's the timeline of the project, but really this project was added because the board looked into the fact that, as Jeff mentioned, there is diversity in practice in the recognition, measurement, presentation, and even the disclosure of government assistance that have been received by business entities, because there is no specific gap right now on that point. And when we did the pre-agenda research, it revealed that there's a limited amount of decision useful information in financial reporting for a wide variety of arrangements for government assistance. And after considering the many types of arrangements, the resources, the amount of time that would be needed to complete a project, a comprehensive project on recognition and measurement, the board decided in 2014 to add a project that would focus on disclosure requirements. And the objective of the project was to increase transparency around government assistance agreements, including the types of assistance, accounting for government assistance, and the effect on an entity's financial statements. So in 2015, the board issued a proposed update on the disclosures. And there was, as you'll note in here, there was a period of time the project was on hold. That was primarily driven by, the urge to get the disclosure framework finalized in terms of what would be in that and if there would be any materiality guidance within the codification. After the redeliberations were done, addressing the issues that were raised on the exposure draft, the board decided to do additional outreach on the costs and benefits of the proposed amendments. Once the additional outreach was performed, fast forward to COVID-19 pandemic hit. And that resulted, as you all know, in a significant increase in government funding that was provided to companies, and investors and other financial statement users requested that additional information about government assistance be disclosed. And in May of 2021, given some of the concerns of costs by some of the preparers, the board decided to narrow the types of arrangements that would be included in the disclosure requirements in order to ensure timely issuance of the disclosures. The expected issuance right now of the final standards is in Q4 of this year. We can go on to the next slide. So the disclosures would apply to business entities. So that is essentially all entities except for non-for-profits and employee benefit plans that account for a transaction with the government by applying a grant or contribution accounting model by analogy to other accounting guidance. So for example, a grant model within IAS 20, accounting for government grants and disclosures of government assistance, or subtopic 958-605 for not-for-profit entities revenue recognition, which is the accounting for contributions. The final standard would be effective for all entities within their scope. For final amendment for financial statements issued for annual periods, again, these disclosures are just annual, beginning after December 15, 2021, and early application is permitted. An entity would apply the amendments either prospectively to all transactions within the scope that are reflected in the financial statements at the date of initial application. So that would be essentially anything that was carried, maybe recorded in a prior year, but carried forward onto the balance sheet, and new transactions that are entered into after the date of initial adoption, or retrospectively to those transactions. So we can move on to the next slide. So this slide has some examples of the types of things that would be in the scope and out, but really you can see that it just depends on how an entity is accounting for those transactions. So, you can see that if there's a forgivable loan from a government where the business entity concludes that it is a grant and accounted for by applying IAS 20 by analogy, that would be within the scope, and or on on the flip side, a cash receipt or other receipt of other assets from a government that might be accounted for as a contribution, those would be within the scope as well. Things that would not be in the scope, or transactions that are accounted for under topic 470, 470 for income taxes, or 740, got that backwards, or revenue recognition, or if you conclude that a transaction is in the scope of other guidance, It could be something that you conclude is in the scope of the debt guidance 470. Those types of things would not be required to be disclosed. Again, it really just depends on how an entity is accounting for the transaction and whether or not they are analogizing to a grant or contribution model by analogy. So we can move on to the next slide. And this just gives an overview of the disclosures. And so the disclosures would be annual. And it would require information about the nature of the transactions, related accounting policy used to account for those transactions, the line items on the balance sheet and income statement that are affected by the transactions, and the amounts applicable to each financial statement line item. Also, the significant terms and conditions of the transaction, including commitments and contingencies. And also, if there is, a restriction, legal restriction within the agreement that some of this information that we would be requiring is prohibited from being disclosed, then an entity would just have to state that the required disclosures are omitted because the information is legally prohibited from being disclosed, and the entity shall disclose the general nature of the information and indicate the omitted disclosures are legally prohibited from being disclosed. These disclosures are very in line with IAS-20's disclosure. So if people are analogizing to IAS-20, then in theory they should be providing these disclosures now. There are a lot of entities that we may account for transactions with the government under the debt model or under some other guidance that we've heard through outreach that they're voluntarily already disclosing some of this information. So in terms of cost benefit equation, this should be was heard by users that it would provide very beneficial information, and the scope being limited to what it is should help with the cost for preparers. So with that, I will turn it over to Jeff to go through the next topic.
Thanks. And before we actually get into the next topic, I did want to answer a couple of questions that have come in with regard to the employee retention credits. The first of those is, can the ERC be netted against payroll? So that depends on which model you use, which accounting model that you use. If you use the IAS-20 model, as I mentioned before, you actually have the choice of either netting the amount received against the corresponding expenses for which it's reimbursing. So in that case, yes, if you were to use the not-for-profit model, the 958-605 model by analogy, or if you're a not-for-profit that's using that model, because that's the only one you can use, that does not permit netting. You would show the amounts gross, and then you keep your payroll intact. And I would argue, especially for a not-for-profit, it actually is probably better reporting to leave the cost structure intact than transparent. Think about all the information that that you disclose, statement or schedule of function and expenses by function and nature and all the other expense-related information. It really is probably better information for users of not-for-profit financial statements not to be doing the netting down. But again, you can only really do that under IAS-20 if you're a business that's analogizing to that. Let me give you the other question, and that is, if a business has both PPP and employee retention credit, is the decision of how to account for the PPP binding on how the business accounts for the ERC? I think that depends on what model you choose for the PPP. If you choose, for example, to treat this as a loan and use the loan forgiveness model, I don't believe that that would be binding on your choice for the ERC, which is not a loan, as we talked about before. It's not in that form in any way. On the other hand, if you, for the PPP, have chosen to use a grant model by analogy, I would believe, in terms of consistency of accounting policy and all that other stuff, that you should be consistent with whatever you analogize to, whether it's 958-605 or IAS-20 across these two programs. Okay, so I think you should be consistent if you've chosen the grant model by analogy, but I don't believe that would be applicable if you've chosen a loan model. Okay, because it's a different type of transaction, different type of accounting. All right. With that, let me close this up and let's move on to the next slide, and that's the reference rate form.
Oh, yes, actually, reference rate comes next. So I missed that one, Jeff. I was turning over to you ahead of time.
Okay. All right, so I'm going to turn it back to Liz for reference reform. Sorry about this here. And then I'll cover the share-based payment practical expedient.
Yeah, okay. So reference rate reform, we can move on to the next slide. Yep. So before I talk about the ASUs issued on reference rate reform, I just wanted to remind everyone about reference rates. So reference rates are variable interest rates that are used to determine the interest rate related cash flows. The most common is the London Interbank Offered Rate, called LIBOR. However, there are other interbank offered rates around the world that are used across various currencies and jurisdictions. Reference to LIBORs are the most common in financial products like lease arrangements and debt arrangements. Reference rate reform is not an accounting initiative, rather it's being driven by the regulators. LIBOR is expected to be discontinued, and therefore contracts containing LIBOR or other reference rates that will be discontinued will need to be updated with a replacement rate. So in March of 2020, the board issued ASU 2020-04. And at a high level, this provides effective relief for entities that have contract modifications, such as modifications to a debt arrangement where the reference rate in the contract is expected to be discontinued. The ASU also provides relief for derivatives in hedging relationships with reference rates that are expected to be discontinued. In January of 2021, the FASB issued another ASU on reference rate reform, which is ASU 2021-01. Specifically, the ASU clarified that certain derivative instruments are within the scope of the guidance. These instruments tend to be held by large financial institutions. The accounting guidance on both of the ASUs includes a sunset provision of December 31st, 2022, meaning that entities may elect to apply the amendments through the end of 2022. On March 5th of 2021, the administrator of LIBOR announced that the U.S. LIBOR will continue to be published until June 30th, 2023. To address the disconnect between the extended date of the discontinuation of LIBOR and the sunset date of the accounting guidance in Topic 848, the FASB is currently evaluating a possible extension of the accounting relief. There also is a current project in which the board will consider developing a principle for identifying interest rates for fair value hedging accounting, both within and outside the United States. Reference rate reform is expected to result in the emergence of new interest rates as alternatives to LIBOR, and other reference rates are expected to be discontinued. So with that, that's the end of reference rates. So now turn it back over to Jeff to go through the PCC.
All right, and now it is indeed my turn. Thanks, Liz.
Now it is you, but you did
Now
have
it
some
is me.
questions before, so that was good. You got those answered.
Okay, so that's great. So I'm going to update you on the project that the PCC has been involved in, trying to provide a practical expedient having to do with share-based payment. And we've gone over this in past webcasts and forums and so forth. So I'm going to both refresh your memory as well as update you on where we are on that project. Let's go on to the next slide. But first, just quick level setting, quick reminder that under current GAAP, share-based payment awards are either classified as liability or equity. Liability classified awards are measured first at fair value at the grant date and then remeasured at each subsequent reporting date with the related compensation cost recognized over the service period of the employee, or in some cases non-employee. Whereas equity classified awards are measured only once at the grant date and the compensation cost is recognized over the service period. And this project focuses on simplifying the determination of the grant date fair value of shares only that are underlying equity classified awards. So let's move on to the next slide. So over the years, the PCC has consistently heard from private company stakeholders that's often costly and complex to determine the fair value of private company share-based awards. When determining the grant date fair value of these awards, evaluation techniques such as an option pricing model is typically used. Black-Scholes being one, but there certainly could be others. An option pricing model requires various inputs, as you know, including the fair value of the equities shares underlying a share-based award. And that's what I'll refer to as the current price input in the rest of this part of the session. So during research and outreach leading to the proposed update, and soon to be final update, the PCC received feedback that current price input is typically the most difficult option pricing model input for private companies to determine. This is primarily because the shares of private companies are often not actively traded, and consequently, there's not an observable market price for these shares. And as you may be aware, there have been the FASB over the years has already granted expedience for some of the other option model inputs for private companies, such as around volatility and expected term of the award. But now we're talking about the underlying current price input. So in response to this feedback, the PCC added this project to its agenda in December 2018. And then in September 2019, the PCC reached a consensus for exposure, which was endorsed by the board in February of 2020. Now, we held off because of the early stages of the pandemic and what everybody was going through. We held off actually issuing a proposed update in this area until August of 2020, and we ended up receiving 24 comment letters. The PCC then redeliberated the expedient, reached a consensus for a final update subject to board endorsement this year at its June meeting. And in August of this year, the board unanimously endorsed the PCC's consensus. The board has finished its balloting process, and all 7 board members ended up voting in favor of the PCC's consensus in the final document. And the final document is going through our production department right now, and we expect it to be issued within the next few weeks. Okay, so keep your eyes out for it. A little bit more about the expedient here. Let's go on to the next slide. The expedient indicates or says that a private company can use the reasonable application of a reasonable valuation method to determine that current price input, and it describes the characteristics of the reasonable application of a reasonable valuation method. Now, though those words are really the same words that are used to describe that approach as in the Treasury regulations related to Section 409A of the Internal Revenue Code. And as a result, the expedient clarifies that Section 409A valuations, having the characteristics described in those Treasury regulations, which would align with the practical expedient as of the issuance date of a final standard. So what the Treasury regs are when the standard gets issued within the coming weeks. Well, anyway, those valuations are acceptable for purposes of determining the current price input for GAAP purposes for topic 718. I'd like to highlight that approach is slightly different than the approach that was taken in the proposed update in the exposure draft, which directly referred to a paragraph in the Treasury regulations. The PCC made the change in response to comment letter feedback that indicated that such a direct reference could result in automatic changes to GAAP, if they were to happen, and that more guidance was needed to evaluate when a previously calculated value would qualify for the practical expedient, such as a share that may have been issued, an award that may have been issued within the last 12 months. For scoping purposes, the PCC decided that the practical expedient should be electable for all equity classified share-based awards within the scope of topic 718, including awards issued to both employees and non-employees. For application, the PCC decided that the practical experience should be applied on a measurement date by measurement date basis. So in other words, all awards that are issued on a particular date and the underlying stock that relates to that. For disclosure, the PCC decided to require a private company to disclose that it is elected to apply the practical expedient, similar to what's done with the other practical expedients in topic 718, such as the couple that I mentioned a little earlier. For a transition, the PCC decided that the practical expedient should be applied prospectively. Move on to the next slide. The practical expedient describes multiple characteristics of a reasonable application of a reasonable valuation method, including the date on which a valuation's reasonableness is evaluated, the factors and scope of information that a reasonable valuation should consider, and when it would be reasonable to use a previously calculated value. Those characteristics are aligned, as I mentioned before, with the Treasury regulations related to Section 409A of the Internal Revenue Code as of the issuance date of this upcoming update. So performing a valuation in accordance with the Treasury regulations is an example of a way to achieve the practical expedient. Let's go on to the next slide. PCC members discussed potential benefits that could be realized in certain circumstances. First, the practical expedient could result in the number of valuations that a company would need to obtain over a 12-month period when an entity updates the valuation to reflect information after the date of the calculation that may have a material effect on the valuation of the entity. Additionally, it can be costly for some entities to evaluate whether there are differences between a Section 409A valuation and a topic A20 valuation, the fair value measurement topic. Because the practical expedience description of a reasonable valuation methodology is aligned with Section 409A's description, this cost may be reduced. And other benefits include a potential reduction of the number of valuations for those companies that currently obtain 2 independent valuations. Not real frequent, but we have heard of some. One for GAAP, one for tax purposes. By codifying that it's an acceptable practice for determining the what's done for 409A purposes under these these parameters is an acceptable practice for determining the current price input in GAAP using the one valuation. And let's go to the last slide in this section. And that is just to remind you that, or tell you that for the effective date, the PCC decided that the practical expedient should be electable for qualifying awards granted or modified during fiscal years beginning on or after December 15th, 2021. So in other words, for calendar year 2022 or interim periods in the following year. Very importantly, early adoption is permitted, including adoption within an interim period for financial statements that have not yet been issued or made available for issuance. And again, the final ASU is expected out shortly. I did have one question that came in prior to the webcast about this. Let me just answer that before I turn this over to Sue Cosper. And that is, how will using Internal Revenue Code Section 409A valuation methodology to measure the fair value of equity classified share-based awards be more cost-effective than current practice? Does the measurement avoid using the Black-Scholes-Merton model? Well, it doesn't avoid having to do a valuation using an appropriate model, whether it's Black-Scholes, a Lattice model, or whatever it ends up being. But what it does do is it simplifies, and it leverages off of what you may already be doing for tax purposes. And there may be some confusion about whether you could leverage about it. So it clarifies that you can, again, as long as within certain parameters. So you may be able to take advantage of that for purposes of what you use for GAAP purposes. And especially it may be advantageous if you've already issued some sort of share-based award within the last 12 months. So there are some benefits, but one of those is not having to avoid entirely, using a pricing option model, for your valuation here. Okay. With that, I'm going to turn it over to Sue, who's going to start us in the next section of the webcast.
Thanks, Jeff. And certainly it's a pleasure to be here today. We're going to spend the next few minutes just talking about some of FASB's implementation activities. And specifically, we're going to talk about our post-implementation review process, as well as some of the comprehensive standards that we're looking at right now and what we've learned from that. So if you want to turn to the next slide, thanks. So specifically, what is our post-implementation review process? And why do we talk about it so much? Well, it's actually part of the standard setting process, and it's embedded in what we do after a standard is issued. And it's really, if you think about what the objective of it is, it's to make sure that our standards meet the objectives for which we thought when we set the standards, they achieve that objective, as well as is the standard operable? Can it be implemented in a cost-efficient way and have the benefits that we thought that were going to be derived manifested themselves? And so when I think about the post-implementation review process, and certainly we've talked a little bit over the years about how it's changed. It used to be a foundation activity, and now it's a board activity. I think when I think about why is that important, I think because it allows us real time to react to some of the issues that we may be hearing about how a standard can be implemented. And it allows us to react in a more timely basis in either actually making some clarifications to the standard itself, and that may be in the form of an ASU, or it could be through educational type material. And certainly we'll talk about some of those activities in a moment. But turning to the next slide, these are really what we call our stages of post-implementation review. And so, for example, we have the period of time from when we actually issue the standard to when it's effective. And you'll see, just as a general marker, our transition resource group activities for some of our projects, understanding what companies are struggling with as they prepare for implementation. And then our second stage is really what we call our post-effective date process, which focuses on costs and benefits. So the standard's now effective, companies implemented it, were the costs what you expected? If they weren't what you expected, why? Talk to investors to understand whether they got the information they needed, how they used that information, whether there was information that they would have liked that they didn't have. And then we have here on the slide just some of the post-implementation review projects in process, if you will. And they're the comprehensive larger projects, revenue, leasing, credit losses. But I think what's important to understand is that for any standard that we issue, we employ a process post-issuance and post-effective date to understand whether or if there's issues. I think the challenge with that is, in some instances, some of the standards are more narrow scoped, but certainly if somebody is having difficulty, we want to hear about it and we want to react to it. So just because we sometimes highlight these more comprehensive projects, we certainly are interested in any feedback we have on all of our projects. And there was a question that came up in the advance questions about, when is the post-implementation review done, and that sort of thing. I think just to highlight that generally speaking, it's a journey, not a sprint. And for example, we'll talk about some of the more specific projects in a moment, but they can range anywhere from 3 to 5 years after a standard is effective. And so when you think about how we've staged effective dates on these projects as well as in projects in the future, they can kind of expand out a little bit. And certainly, as we talk about revenue, which we will in a moment, you can see that, we're in a certain stage for public companies, but we're just beginning for private companies since the standard just went effective. Lastly, what I just focus on here is, certainly if you observe any of our meetings, that the staff periodically update the board on the results of what they've found through some of the post-implementation review procedures, as well as regularly updating our oversight committee of the Board of Trustees, who monitor to make sure that we are effectively following the process that we set out to in these post-implementation reviews, as well as they do for all of our standard setting activities. So moving on to the next slide, I wanted to just speak a bit about effective dates. Certainly over the last few years, we've had some changes to the effective dates, not only just the effective dates themselves, but I'll call it the effective date methodology. And for two things, one is we are now, from the more comprehensive standards, sort of isolating out SEC filers versus SRCs, small reporting companies, and allowing either them to have a different effective date or to include them in the same category as all other entities or private companies and not-for-profits. But I just wanted to mention that because I think what's important in having staged effective dates is when you think about this post-implementation review procedures, it allows us to learn from the public company adoptions. And to the extent there are things that need to be tweaked or clarified, we can do so in advance of the next tier of effective dates. And so in this instance, on this slide, I really just wanted to highlight two projects really, or two standards. One is leases. Certainly we deferred that effective date twice now. One was when we thought about the staged effective date, as well as for the COVID-19 pandemic. And the credit loss standard, which is now effective January 2023, leases is effective for annual periods ending after 2022. And at this point, we don't have any plans to extend any of these effective dates. But as I said before, the staggered effective dates really allow for us to learn from the public companies. And as I think we've heard from the auditors as well as private companies, they also learn from what they see others doing when they do adopt these standards. So on the next slide, just to highlight in your materials, there is a link to our website, which actually has a nice list of effective dates. If you want to use that as a tool or as a resource on a go-forward basis, that's what it's there for. Well, let's talk about revenue recognition. Certainly that was the first of our comprehensive standards to become effective. And I think what we wanted to do is just talk a little bit about some of our post-implementation review activities and what we've learned from those activities. So, where are we? Well, we are in phase 2 for public companies, which is the post-effective date procedures. And, really that stage is where we're talking to companies, we're talking to their auditors, and we're talking to investors to understand the costs and the benefits of implementing the standard. And certainly as part of that process, we have talked to a number of different folks. You can see from the slide. We've also had multiple public meetings where we've talked to the board about what we've learned from the post-implementation review activities. We've had surveys. We've talked to liaison groups like FEI and others, the AICPA, to understand really what questions may be in the system out there. And we've also had webcasts. And so, for example, we had a webcast a couple of years back for private companies specifically and not-for-profits on, what we've learned from the public company adoption. So there are still a number of resources and tools on our website. The educational material is deep. And for example, from our transition resource group meetings, we developed a Q&A in a sort of user-friendly way that has and discusses over 80 different specific issues in a easy question and answer format. And so our website also has several educational memorandums, particularly from the private company perspective on out-of-pocket expenses, as well as short cycle manufacturing, and webinars to help those that maybe have some concerns or issues that they want to have addressed. So what did we hear from some of that feedback? Well, I would say that, I'll do the middle one first, which is what were the cost drivers? Because that's certainly what we look at first while it's fresh in everyone's mind. And this is public company feedback. We learned that, the costs that contributed to the implementation were really 3 things. Contract reviews, that was really a substantial aspect of the cost, understanding what's in the contract and how their, identification of performance obligations, as well as variable consideration, and then just the effects of the regulatory environment. But counter to that, what were some of the benefits? I think what we learned is, even if in circumstances where, let's just say, for example, some have indicated that, well, maybe we didn't have a change in revenue. And certainly the standard itself affected different industries differently. And in some instances, you might have significant recognition and measurement differences. Then in other instances, you may not. But the disclosure aspects of the standard were affected all companies because they were a lot more comprehensive than what we've had in the past. And then also what we learned is that there's certainly better comparability, certain transactions that are economically similar are treated similarly under the standard. I think investors told us that they thought that the entity's performance had a better depiction in the financial statements. And a byproduct that we probably didn't even contemplate was that companies had a better handle on what was in their contracts. There was better communication internally between the finance folks and the operational folks to understand, what commitments they were making as part of their contracts. And so that was a nice byproduct. So as I said, for private companies, we're just beginning phase 2, where we're actually reaching out to them now and getting a better handle on costs and some of the challenges they had in implementing the standards. As far as continued challenges, I think that, identifying performance obligations, I think what we're hearing is determining whether something is distinct in context of the contract is a challenge. Principal versus agent, that's sort of gross versus net presentation. I think that, some of the arrangements in today's world are much more complicated than when that guidance was originally written, although it has been updated since the issuance of the standard. I suspect that's an area that we'll continue to hear about in our agenda ITC, which Nellie's going to talk about later. And then consideration payable to a customer is really about determining variable consideration, which is a new aspect of the 606 guidance. So with that, I'd like to just turn to one of the recent ASUs that we issued. And this was really geared towards the franchise industry and the private company franchisors. And specifically, we had a number of conversations with that industry over, I would say, spanning a couple of years prior to their implementation. And specifically, they were struggling with the upfront franchise fee, particularly. And under 605, they recognized it over time, and over 606, there was some concerns that absent actually evaluating the contract, there was a sentiment in the public marketplace that these costs should be, or this revenue should be recognized up front. What we had said, and we issued a number of educational materials, is you got to evaluate the contract. You may have certain items within that upfront fee that are distinct in the context of the contract and can't be recognized over time versus those that may be recognized up front. And so even though we had issued many educational papers, did a podcast, we had talked to practitioners, we did educational sessions, it still seemed that the industry was struggling, and smaller practitioners specifically were struggling with that. And so what we decided to do is we actually decided that for a very limited number of services in the pre-opening phase, which is detailed out in the ASU itself, we would allow them an expedient to say this is distinct in the context of the contract. And so from that perspective, they still have to follow all of the additional guidance in 606, but for a certain small population of pre-opening services, they will have that expedient. And so it's ASU 2021-02, and it's effective for annual periods ending after 2020. And so it's interim 2021. So it should be effective already for most companies. So now I'd like to turn to our credit loss standard, particularly, fondly referred to as CECL. Certainly there's been much focus in the past year on, and actually past several years, on educating smaller financial institutions, along with the efforts of the bank regulators and examiners on how to apply the model, and including, certain what I'll call scalable methodologies. We have many good educational resources on our website on certain aspects of the model, including the WARM methodology, which is the weighted average maturity, remaining maturity, and also Q&As on reasonable and supportable. But before I go into some of those and some of the other activities we have underway, I thought I'd just talk a little bit about where we are with respect to the post-implementation review process, particularly for this standard. So for public companies, it was adopted at the beginning of 2020. Certainly a challenging time for many. And, the banks with the changing economic environment certainly had their work cut out for them. But they were prepared. And, from all of the discussions that we've had, and you can see here on the slide, we talked to 120 different stakeholders, and that actually translates to about 230 separate meetings and interactions with folks to try and understand how it went. And, if I had to synthesize it down, they were prepared. They were very happy that they had done a lot of the upfront work in terms of parallel testing and to be able to respond quickly to the changing economic environment that the pandemic posed to us. And no doubt they had challenges with respect to understanding what the impact of some of these government programs would have, but at least they were prepared. But as part of the PIR, we've had a public roundtable in May of 2021 where we talked just about general feedback. We also talked about TDR accounting, troubled debt restructuring accounting, as well as accounting for purchase credit deteriorated assets in a business combination. We've held multiple educational workshops, and the staff continue to monitor the disclosures that are in the 10Ks and 10Qs and that are disclosed as part of earnings call and certainly the regulatory call reports. And we've also continued to respond to technical inquiries and additional implementation questions as needed. Turning to the next slide, this really just captures some of what we've heard so far from public companies. From a user perspective, I think that users have overwhelmingly indicated their support for some of the incremental information that's been provided as part of the standard. There's a lot more transparency than there was previously. And although I would say, constructively, there certainly was some criticism about the lack of consistency in certain disclosures across financial institutions. And for example, that really came out of the first and second quarter when and certainly it was the changing economic environment and understanding specifically some of the assumptions that different institutions were using from a macroeconomic perspective. And so the other feedback that we've heard is that, it's certainly been challenging, that the upfront activities, as I mentioned previously, helped them tremendously. I think that from community bank perspective, I think what we've been hearing is the most significant challenge is with respect to data. And certainly the banking regulators have recently shared a methodology called SCALE, which helps the smaller financial institutions with their data issues, particularly by allowing them to use peer data, which is acceptable under the standard. And so from those that haven't adopted yet, it's about educating them about their implementation efforts, about what methodology they're going to use. And, we have heard that many will be using an outside vendor. And certainly there is a handful of smaller institutions that have adopted in advance of the effective date, which is 2023 for those smaller institutions. I did get a question, I think, before I turn to some of our recent standard setting activities, and it was particular to accounts receivable. And I know that, when we talk about CECL, we often focus on the financial institutions, but certainly it does affect all companies with respect to any company that has accounts receivable, for example. And, and certainly from my perspective, they have to apply the standard in the same manner as other entities. But I do think it's somewhat easier. And in many instances, what we learned when we developed the standard is that many companies already are employing a type of expected loss model with respect to accounts receivable. So for example, you still have to look at historical information, current conditions, and reasonable supportable forecasts. Okay, well, how does that translate down? Well, you're going to look at, maybe you're going to stratify your accounts receivable by similar risk characteristics. So for example, many instances, at least what I remember from my previous audit days, is companies look at it in delinquency status. Okay, it's current, it's 0 to 30 days, or I guess that's current, 0 to 30 days, it's 30 to 60, 61 to 90, over 90, and they have different reserving methodologies for each of those categories. That's a sort of expected loss model, considering you're using that delinquency status as a way to calculate you're using historical experience based on that category. The only thing that I would suggest is, you have to consider to overlay that with what you might expect in the future for current and future economic conditions. And that could be a change in employment rates. It could be in the area that you operate. Maybe there's some significant event that has occurred. But I think from what I understand is the one area where maybe companies will have to think a little more close or look at it a little more closely is just the current category and whether there is any reserving that may need to occur in that category, thinking about historical experience, current conditions, and reasonable and supportable forecasts. So I didn't want to let the opportunity pass by without a chance to talk about accounts receivable, but so I wanted to mention that. But moving on, I did want to mention that we do have some standard setting activities underway, and specifically, we've recently added 2 projects to the agenda. One is the accounting for acquired financial assets in a business combination. This is really the purchase credit deteriorated issue, and I'll talk about it in a minute. We've also added a project on TDRs, troubled debt restructurings. The guidance was largely unchanged by the issuance of ASU 2016-13, which is shorthand for CECL. And at the same time, we're also looking at disclosures. And in addition, we also reaffirmed the board's interest in a project on vintage disclosures, and we'll talk about that more in just a minute. So moving on to TDRs, and we actually are talking about this project tomorrow at tomorrow's board meeting. But I think what we learned is, if you think about TDRs originally under an incurred loss model, TDRs were the catalyst, if you will, for a change in recognition between an incurred loss and an expected loss model. And so under a CECL regime, if you will, in an expected loss model, it doesn't have as much impact as it used to have. So, you have a TDR when you have financial difficulty and you have a concession. Under the credit loss model, the expected credit loss model, a TDR, as for purposes of calculating your expected credit loss, it requires a DCF, a discounted cash flow methodology. But it still is an expected loss model. Whether it was an expected loss model before it was designated TDR or after it was designated TDR. So really what becomes more important are the disclosures. And what we've learned through a tremendous amount of outreach is that certainly there are some redundancy in those disclosures, and what investors are really more interested in rather than the actual troubled debt restructuring disclosures is really understanding disclosures about modifications that had concessions, and where the modification was with a borrower that had financial difficulty, and whether or not the modifications were successful. And so that's what we'll be talking about tomorrow. I think that, for those entities that have yet to adopt CECL or an expected credit loss model, TDRs will remain in place. This is really just focused on for those entities that have actually already adopted the expected credit loss model. So watch this space. We'll be talking about it tomorrow. And in absence of the recognition and measurement guidance in TDRs, what we will be focusing on is whether or if the appropriate accounting is for those entities to apply modification accounting in all circumstances. So with that, I think that this next slide really just talks about some of the feedback that we got on the disclosures. I think I already mentioned this mostly with respect to understanding the success. You can see there number of loans that have been modified, duration, and reperformance of the loans after modification. In other words, were they successful or did they default? Okay, moving on to the next topic I wanted to mention is really around purchase credit deteriorated, PCD for short. We actually added this project to the agenda in July with the idea of understanding whether or if this accounting should be modified or improved. I think what we understood from investors from the feedback that we from the outreach that we conducted with investors is that there's some complexity in the information that they're receiving from a business combination, where a portion of a portfolio will qualify as purchase credit deteriorated, and so it's grossed up on the balance sheet, and a portion does not. And so they have different impacts on the financial statements. And so that is confusing to investors. And so I think at the board at the time, as they developed the standard, really had a perspective that in most instances, loans that were acquired in a business combination would qualify for purchase credit deteriorated and be grossed up. But really what has the outcome that we've observed in practice following the issuance of the standard and effective date of the standard is that it's just the opposite. In most instances, they don't qualify for purchase credit deteriorated. And certainly there's a threshold that one must meet to be credit purchase deteriorated. And it's hard to understand whether there's, certain stigma with that in terms of having an acquisition and knowing that you've acquired something that's got a label that's purchase credit deteriorated, or whether it has something more to do with it. So we've done a number of analyses on some recent acquisitions. We're having discussions with the board and certainly conducting outreach as we pursue down this path of what we might do here. And certainly there is a spectrum of feedback on whether we should do anything or we should actually have a circumstance where in every business combinations, all loans that are purchased should be considered purchase credit deteriorated. And maybe that's actually the wrong label. But anyway, the staff is conducting research right now, and we'll be talking about it at a future board meeting. And then lastly, I wanted to talk about vintage disclosures. Vintage disclosures were a significant improvement for the CECL model and significant improvement for investors in understanding and providing transparency on the expected credit loss model and the allowance. And certainly, this is actually a great example of PIR in play, because this was one of those instances where this project talks about whether gross write-offs or gross recoveries and/or should be included in the vintage disclosure table. And the vintage disclosure table has been very well received by investors. And, when we issued the standard, we had an example in the standard itself. And in the example, it included gross write-offs and gross recoveries. But in the standard itself, the words didn't actually say that. So rightfully, we got a question after the standard was issued saying, but the standard doesn't say this, but the example includes this. Are we supposed to include it or not? And as we talked about it as a board, we decided at the time, because what we learned from preparers is that this isn't an insignificant question because of the systems changes that were needed to get the information. And what they told us is it would be very difficult to get it in time for the standard itself for the 2020 adoption. This was public companies. And as a result, what the board decided at the time was, well, let's just add it to the agenda. We'll talk about it and improve that after the fact, allow companies to get on with their implementation without the distraction of this particular item. And so we've now come back around to this, and the board recently reaffirmed their desire to add this project to the agenda and make some improvements here. And this is also one that we'll be talking about tomorrow on whether we want to add gross write-offs and gross recoveries to the vintage table. So watch this space. And with that, I think that, let's see here, I think the next speaker is Bobby Gwynn, and she's going to talk about leasing.
Good afternoon. It's a pleasure to be here. I'll start with an overview of post-implementation activities related to topic 842 leases, and then I'll discuss two most recent standard setting activities on leases. So this slide provides a quick overview of the board activities and standard setting activities since the issuance of the leases standard in 2016. The board meetings and standard setting activities relate to various post-issuance or post-implementation issues that were raised by our stakeholders. So far, the board has issued 6 updates to assist stakeholders with implementation issues and 2 updates deferring the effective date for private companies and certain not-for-profit organizations. Additionally, the board is currently finalizing a proposed update for private companies and certain not-for-profit organizations, which we'll go over in a few minutes. Overall, the key message we want to convey here is that the board and staff continue to engage with stakeholders and stand ready to assist with implementation questions for private companies or any post-implementation questions. Any inquiries could be submitted via the technical inquiry service on the FASB website. We can move to the next slide, please. So here we have a very high-level summary of what we have heard from our stakeholders so far. As you may know, public companies adopted 842 for fiscal years 2019. So we have been engaging with preparers, practitioners, and users of financial statements to understand how the implementation went and how the information is being used. Overall, the users have provided us mixed feedback. We collected feedback on whether and how they're using the operating lease assets and lease liabilities reported under topic 842, the dual lease classification model, and the related disclosures. While some users are using the reported lease assets and liabilities as is, others are either continuing to use their legacy analysis, which is 6 to 8 times, a multiple of 6 to 8 times the lease expense, or they're using the numbers reported under 842 with certain adjustments to it. On dual lease classification model also, we received mixed feedback. While some appreciated that the board retained dual classification model, some noted a preference for breaking down the single operating lease cost into interest and amortization. Overall, we continue to hear that this is still early stages of new information coming in, and the users are continuing to evaluate those disclosures and trends. And there were certain improvements recommended to existing disclosures under 842 as well. In outreach with preparers and practitioners, as I noted before, we wanted to understand how the implementation went, what were the implementation costs and complexities, and whether there are areas of continuing complexity, areas of recurring costs, and if there is a need for standard setting to address any of those issues. So we heard from our stakeholders there were about various complexities that they dealt with when implementing the standard, for example, identifying embedded leases or incremental borrowing rate for lessees. However, overall, the sentiment was that there's no appetite for any fundamental changes right now, for example, to the definition of lease. The feedback we collected, we continue to collect it in our non-public meetings with stakeholders, as well as there were 2 public roundtable held in September 2020. And there were certain areas of improvement that were recommended, for example, certain narrow scope changes to lease modification model. And overall, the message was to continue with the educational efforts as private companies go about implementing topic 842. So we can move on to the next slide. So this is an overview of PIR activities on leases. While public company implementation is complete, we continue to monitor private company implementation. We continue to engage with our stakeholders to continuously hear from them any feedback they have. And additionally, in the coming days, stage 2, we are going to engage in academic discussions. We'll be doing analysis of public company filings and a survey on implementation and ongoing costs. There's more to come on that in the coming days. In terms of technical activities, the board recently issued an update on specific to lessors related to certain leases with variable payments, and reached final decisions on a proposed update last month that is specific to non-public entities, and I'll go over those in the next slides. Additionally, there is a project on lease modification accounting on the agenda, which is currently in early stages. And the board and staff continue to consider and address agenda requests or technical inquiries as they come in. We can move to the next slide, please. So this ASU 2021-05 was issued in July of this year, and it amends lessor's lease classification requirement in topic 842 for certain leases with variable payments. Before the effectiveness of this update, topic 842 required a lessor to determine lease classification based on certain specified classification criteria. For a lease with certain magnitude of variable payments, while the sales type lease classification criteria may be met, the net investment in that lease may be less than the carrying amount of the underlying asset derecognized at lease commencement. This is because variable payments are not estimated and recognized by a lessor. As a result, the lessor was required to recognize a selling loss at lease commencement or a day one loss, even if the lessor expected the arrangement to be profitable overall. This issue was raised by stakeholders in an agenda request. The amendments in this update amend the lease classification requirement for lessors to align them with practice under topic 840. Lessors are now required to classify and account for a lease with variable payments that do not depend on a reference index or a rate as an operating lease if the lease would have been classified as a sales type or direct financing lease, and the lessor would have otherwise recognized a selling loss at lease commencement. So this would address the issue of day one loss recognition. When a lease is classified as operating, the lessor does not derecognize the underlying asset, does not recognize a net investment in the lease, and does not recognize a selling profit or loss. The leased asset remains on the lessor's balance sheet and continues to be subject to the measurement and impairment guidance in other applicable GAAP before and after the lease transaction. You can move to the next slide on transition. So this update is effective for fiscal years beginning after December 15, 2021 for all entities, and interim periods within those fiscal years for public business entities, and interim periods within fiscal years beginning after December 15, 2022, a year later for all other entities. Note that for the entities that have not yet adopted topic 842, the transition for this update is aligned with the transition date for topic 842, and earlier application is permitted. Now I'm going to talk about the proposed update discount rate for lessees that are not public business entities. This project relates to the existing practical expedient in topic 842 that allows a lessee that is not a public business entity to use a risk-free rate as the discount rate for all of its leases. As you may know, the discount rate is used by a lessee to discount the lease cash outflows to calculate the lease liability. This issue was highlighted at the public roundtables in September 2020, and suggestions were made to improve the existing expedient. And the board finalized its decision last month, and an ASU is expected in Q4 of this year. If we can move to the next slide, please. The decision as finalized would allow a lessee to apply the risk-free rate election by asset class rather than to the entity as a whole. Lessees would be required to provide disclosures about what classes of asset the entity has applied the expedient to. Lessees would be required to use the rate implicit in the lease wherever it is readily determinable. And I want to highlight that this ASU is not, when issued, is not intended to change practice around when the rate implicit in lease is readily determinable. I want to point out also that the board retained the risk-free rate rather than any other rate, such as a corporate bond rate, because the risk-free rate is publicly available, and available for different maturities. When finalized, if we can move to the next slide, please. When finalized, the amendments would be applied by entities that have not yet adopted Topic 842 upon the initial application of Topic 842. For entities that have adopted Topic 842, the standard would be effective for fiscal years after December 15, 2021, with earlier application permitted. A modified retrospective transition method and certain disclosures would be required. And that brings us up to date on post-implementation activities on leases. I have one question that was submitted in advance and I want to answer. The question is, if an agreement contains an embedded lease from the standpoint of the lessee, is the lessor or counterparty also required to account for the lease features of the contract as a lease under Topic 842? So the guidance requires, whether Topic 842 or Topic 840 really, the guidance requires an entity, whether a lessee or a lessor, to determine if a contract is or contains a lease. And that determination is made by the lessee or lessor based on the information or evidence they have. It is independent of the counterparty evaluation. That said, both lessee and lessor are required to evaluate their arrangements to determine if it is or contains a lease. Because the question is from a lessor's perspective, I do want to point out there's a practical expedient in paragraph 842-10-15-42A, which allows lessors to combine lease and non-lease components and account for them as one component under either 606 or 842, depending on which component is predominant. There's certain additional criteria that needs to be met. I just wanted to point that expedient out. So with that, I'll hand it over to Liz to continue.
Okay, thanks, Bobby. So I don't see any additional questions on leases, so I'm just going to move on to gifts in kind. Now, I'm not going to spend too much time on these slides. We did discuss them at the last in June, the CPE provider form in June, so you can always go back to listen to that webcast for more detail. But just as a reminder, so this ASU was issued in September of 2020. And the goal is to increase transparency around contributed non-financial assets and how those assets are both used and valued by not-for-profit entities, especially those gifts in kind that an organization uses in the conduct of its programs and other activities. The scope of the non-financial assets includes fixed assets, materials and supplies such as food, clothing, or pharmaceuticals, intangible assets, and certain services. So moving on to the next slide, the new standard has several presentation and disclosure requirements. So I'm not going to read through all these, but these were all described on the last webcast, but here are just kind of an overall summary of what the requirements are. On the next slide, this tells you the amendments will be effective for annual periods starting after June 15th, 2021, and interim periods within fiscal years after June 15th, 2022. So this means that entities with a June 30th year end would need to adopt the standard for their 2021-2022 fiscal year. Early adoption is permitted and retrospective application is required, meaning that entities must apply the amendments to gifts in kind for all periods presented within a not-for-profit's financial statements. As part of our educational efforts on the standard, the FASB held a webcast that provided an overview of the standard and its requirements, as well as the illustration of certain considerations when valuing non-financial contributed financial assets. The archive of the webcast is currently available for viewing on the FASB website. So you can also go there as well, and that provides an actual more in-depth guidance and presentation on how to apply the guidance. So with that, I think we can turn it over to Nellie, who's going to take us to current projects.
Great. Thank you, Liz. All right, now we're going to talk about a couple of our ongoing projects and initiatives. I will start with the agenda consultation. As many of you may be aware, in January, we kicked off our 2021 agenda consultation process to understand what kind of priority topics our stakeholders think that we should address. So what's so interesting to me about this process is that we spent significant time and effort soliciting views directly from our stakeholders before issuing the invitation to comment document. So throughout the first half of 2021, the FASB staff conducted outreach with advisory groups, key stakeholder groups, in order to identify priority areas of financial reporting. So we spoke to a wide cross-section of our stakeholders, including investors, preparers, practitioners, academics. We discussed the feedback we had received from those conversations with the Financial Accounting Standards Advisory Council, FASAC, and asked for their views on the identified priority areas or to suggest anything else they wanted to talk about. We ended up speaking to over 200 stakeholders as part of that process, and over 1/3 of those were investors. So all of that feedback was synthesized and organized into the agenda consultation invitation to comment document, which was issued with great fanfare in June. Comments were due, as you can see, in September. We've received over 500 comment letters, which is phenomenal. Now we are reviewing and analyzing, and then we'll come back to the board in public meetings to consider what projects should be added to the board's technical or research agendas in the future and how those should be prioritized. Our first meeting to begin that process is anticipated in the fourth quarter, and we think that the board will begin to analyze changes to the agenda at the beginning of 2022. So if we can go to the next slide. As I mentioned, we heard a wide variety of topics and suggestions from all of the stakeholders that we spoke to over the process of putting this document together. We were generally able to group what we heard into the 4 categories that you see here. So first, we've heard from investors and other stakeholders that they wanted greater disaggregation, which can help investors better understand performance and forecast future cash flows. A couple examples discussed in the ITC of areas where incremental disaggregation is requested is business combinations, ESG related information, income taxes, and performance information, including both the income statement and the statement of cash flows. Next, we heard about various types of emerging transactions. So this is areas where there's no specific topical authoritative guidance or where the current accounting outcomes are maybe not intuitive. A few areas of this, examples of this area that are discussed in the ITC are the definition of a derivative, non-GAAP metrics, government grants, and intangible assets, as well as a key example of this is digital assets. A fair number of the comment letters we received do relate to this issue, and so we're reviewing that feedback on that area and all the others, and we'll be discussing that in our subsequent meetings. Next, we heard about some of the specific areas of existing GAAP that may need to be reevaluated. These are possible places where unnecessary cost and complexity might exist in the financial reporting system. So a couple of the examples discussed in the ITC of this are consolidation, debt modifications, and distinguishing liabilities from equity. And finally, we heard that in a few places there could be enhancements to certain FASB processes to increase transparency and communication. So we talk a bit in the document about making the codification more accessible, our cost benefit analysis that we, the FASB, conduct, the process of providing interpretations of FASB guidance, and our transition and effective date requirements. And again, everything that I mentioned or ran through here is discussed in much more detail in the actual ITC agenda consultation document. So please refer to that directly. That could be a fruitful source of discussion. So we've got a lot to think through, and we got a lot of fantastic input through our comment letter responses. And the FASB staff will continue to process all of the feedback we've received, and we'll discuss it with the board and with you all if you join to listen in the fourth quarter. If we can go to the next slide, sorry. Okay, so I want to say a few things briefly about our project on the accounting for acquired revenue contracts and deferred revenue balances in a business combination under topic 805. So this project arose from some diversity in practice. After the adoption of topic 606, the definition of a performance obligation in that standard did not align with the general practice of accounting for deferred revenue in a business combination, which analogizes some old guidance and recognized deferred revenue only if that represented a legal obligation of the acquiring entity. So this diversity in practice also led to some confusion by investors. Acquired contracts and originated contracts would have different accounting, and investors told us that revenue was an area where it's particularly important for investors to understand trends over time. As such, investors have been spending a lot of time trying to understand the accounting for acquisitions, especially in certain industries, and preparers have spent a lot of time explaining that accounting. So the board took on this project and we issued an exposure draft in December 2020. The December 2020 exposure draft requires an entity to account for acquired contract assets and contract liabilities as if the acquirer had originated the contract themselves and applying topic 606 to those contract assets and contract liabilities. So what does that mean? It means that the acquirer would be assessing the contract and recognizing the contract assets or liabilities based on the guidance in 606. So to make that assessment, the acquirer can review the accounting done by the target if that's well documented, well supported, free of errors accounting. Then the acquirer may be able to record the contract asset and contract liability balances that the target had in its financial statements, but the responsibility rests with the acquirer to review the accounting and make that assessment as to the application of topic 606 to those contracts. As this slide notes, there are some practical expedients provided regarding modified contracts and standalone selling price specifically. And we are working through the finalization of this standard, so we're expecting to issue that early in the fourth quarter, which is very soon. So looking forward to that. If we can go to the next slide. Kind of continuing on with our current projects, we're going to talk about improving the accounting for asset acquisitions and business combinations. We began working on actively in 2017. The objective is to narrow the differences in the accounting for assets acquired inside and outside of business combinations. Initially, this project focused on 3 areas of differences: contingent consideration, acquisition costs, and in-process research and development. In 2020, the board did decide to remove the IPR&D piece, in-process research and development, from the scope of the project. And most recently, we have focused on narrowing the differences in the accounting for contingent consideration. Next slide, please. So this is summarizing current GAAP. Got a lot of detail here. You've got the slides to refer to as well. This summarizes the difference that exists in the accounting for contingent consideration under current GAAP. That asterisk is indicating assuming the contingent consideration is not accounted for as a derivative. So I'll talk about 2 of these scenarios on the far right and the far left. As you can see, there's some other scenarios in the middle that are somewhat less common. In the case of an asset acquisition, there is no explicit guidance for contingent consideration. Some entities apply a FASB type model and record contingent consideration when the amount is probable and reasonably estimable. Some entities recognize a liability up to the amount that would otherwise be recognized as negative goodwill by analogy to equity method accounting, and some entities do not account for the provision until the contingency is resolved. Either way, in an asset acquisition, subsequent adjustments are generally considered an adjustment to the cost of the asset. On the right side of this slide, on the other hand, business combinations, however, contingent consideration is recognized at the acquisition date at fair value, and subsequent changes in the fair value in that estimate are recognized as gains or losses in earnings. So that's a very dramatic difference in accounting outcomes. Generally, users generally tell us they would prefer the accounting to be aligned. There's some indication that users may find the fair value of the provision to be useful information, the contingent consideration provision to be useful information about what the entity expects to pay or receive. They're interested in, forecasting future cash flows, what is going to be paid or received at the end of the day. And the changes in fair value in subsequent periods can, in some cases, provide an indication of how the arrangement changes over time or how the likelihood changes over time. Preparers likely also favor alignment. But among preparers, there's maybe some more support for a FASB or probable reasonably estimable type model that provides more information about when the arrangement is actually likely to occur or likely to be paid, and has can have fewer changes over time. The fair value remeasurement of fair value at fair value every reporting period can be costly. So this is an area where the board is currently working. We expect to come back to the board to discuss this, potentially in the fourth quarter. We'll discuss more about how these models might evolve. Next slide. And then lastly, improving The accounting also includes these related costs. This is another area where there's a difference in this accounting. You can see this slide summarizes the differences in that accounting. This topic regarding these costs has not yet come back to be discussed in detail by the board. So we'll continue working on this, but as we work towards alignment and finding ways to align these models, this is part of what we're thinking about as well. So with that, I don't know if there's any questions on any of that, but if not, seeing none, I guess. Jeff, I think you're going to talk about our project on goodwill next.
I am indeed, Nellie. Thank you. So I'm going to be quick here and just really focus on where we are in this project. You can go to the next slide. As a reminder, this is a project to look at trying to better balance the cost and benefit of accounting for goodwill, specifically for public business entities, who are the one group of stakeholders who don't have the option now to amortize goodwill. But potentially some of the things we do could be beneficial for the system as a whole. You may remember that we issued an invitation to comment on this in the middle of 2019, and we held some roundtables in the latter part of this year, and then had to slow down the project a little bit during the first part of 2020 to focus on some of the financial reporting issues having to do with the pandemic. We reported out in the last forum, 6 months ago, we talked about the December 2020 board meeting, where the board did discuss details of a potential amortization model to add to the already impairment only model. So this would be an impairment with amortization model. And we mentioned there that the board tentatively decided that goodwill would be amortized over a 10-year default period, but with the ability for the company to justify a shorter or longer period. In the case of a longer period, potentially subject to a cap, and that this amortization would be straight line. So since the last forum, we met with the board on April 7th. We discussed some more details of an amortization period and how that could be determined if a default 10-year period were not chosen. The board, as I said, discussed that with us, but sent us back to do some additional research in this area. And we'll be talking with the board about that on October 27th and seeing if we can if the board will have some stronger leanings in this area. We also, at that meeting, talked a little bit about whether it made sense to subsume certain intangible assets into goodwill if goodwill is amortized, similar to what we already have, or maybe a little different than what we already have in the private company and not-for-profit alternative. Again, the board asked us to do some additional research, and we'll be coming back to the board on that in a future meeting. And then on June 23rd, we met with the board, and the board discussed potential changes to the existing impairment model, focusing on 3 areas. First, should we change the unit of account, meaning the level at which goodwill impairment testing is done? Should it remain a reporting unit, or should we potentially move to other units of accounts, such as an operating segment or a reportable segment? The second thing that the board discussed was the frequency of the testing. Should there remain an annual impairment requirement, such as there currently is in GAAP, or similar to what we have for private companies and not-for-profits who've elected that alternative to amortize goodwill? Should we just go to a trigger-based impairment model only? And then finally, the timing of the assessment. Does it need to be at the time of any trigger-based events or circumstances, or similar to what we've already done with ASU 2021-03 for private companies and not-for-profits? Could it be at the end of a reporting period? In the case of a public business entity, it would be at the end of the next quarter, because that is the frequency with which they report GAAP financial statements. Let's move on to the next slide. This is, as you can imagine, this is a very interesting project. Lots of stakeholders are indeed very interested in it. We are monitoring a similar project that the International Accounting Standards Board, the IASB, has on their agenda, and we're waiting to see, and we're each watching to see where one another goes, and we'll see where they go. There are a number of areas that still need to be discussed besides the ones with which I mentioned that we're already coming back to the board on in the near future. We still have to ultimately discuss any disclosures that arise as a result of decisions that the board makes in this area. We still have to talk about presentation, where in the financial statements goodwill amortization would be presented. We still have to talk a little bit about scope. Should this just be for public business entities? Is anything we'd want to extend to the system as a whole? Should this be an option? Should it be required? You know, all that sort of thing. And then a very, very interesting issue, which is transition. You have literally trillions of dollars of goodwill on the balance sheets of companies. What should we be doing here in terms of moving to an amortization approach? What about the existing balances for old goodwill that's been on there for a while? What are the possible ways in which we might go? So lots of things to discuss through the rest of 2021, and into 2022. Our best guess at this point for the timing of an exposure draft here, proposed set of potential changes here, would be sometime in the latter part of 2022. But again, as I said, we're a lot still to talk about, and we're also monitoring what the IASB is doing. So that timing is very much up in the air. So with that, let me turn it back to Liz, who's going to wrap us up. And I think I may have one more question to answer that's come in. But let me turn it to Liz first.
Okay, thanks, Jeff. So the next couple of slides, not going to go into too much detail. And also, I want to make sure we have time for the one last question, but you can go to the next slide. This just really gives an overview of just some of the projects from the board's agenda. It doesn't have everything on here, but just some of the projects. And there is a link that you will see that can be found that will take you right to the FASB website and has the technical agenda there. And again, as Nellie mentioned with the agenda consultation, as they go through that, as the board goes through that, the projects may change and some of the priorities may shift. We can go to the next slide. This just gives an update of the recently issued ASUs. Again, not all of them, but most of them, and then some things that are on the horizon to come. Some of these we talked about during the presentation, but just for reference, you can look at these. If you have any questions on anything here, feel free to let us know. But Jeff, I'll just turn it back to you and have you answer that question that we got.
Yeah. Thank you, Liz. There was one additional question about the area of the PCC share-based payment practical expedient. Here's the question. If private companies are already obtaining a 409A valuation at every grant date, or at least quarterly, and some I suppose could be doing that, is there really any benefit to be obtained from this expedient? Well, we've heard mixed things about practice here, but if to the extent that companies are already leveraging off of those kind of valuations and being able to use them for their GAAP valuations under topic 718, well, there may not be a lot of benefit to be obtained. However, if there, to the extent that there's any question out there as to circumstances under which these can be leveraged, and therefore whether you really need to obtain a separate valuation or do something additional, to meet the requirements for GAAP financial statements. The fact that we've aligned the characteristics that are in Section 409A and the regulations to that, within this expedient, and we say that this expedient, if it follows those characteristics, the evaluation follows that characteristics is in accordance with GAAP, then that may eliminate some of that uncertainty and diversity in practice, and it could result in some benefit. Again, but there may be lots of companies that aren't obtaining 409A valuations quite that frequently, and especially when you award multiple share-based payment awards within a 12-month period, there may be some good ability to leverage off of valuations done within the last 12 months. So some benefit depending on the company and depending on what they're currently doing.
All right, thanks, Jeff. So that concludes our semi-annual CPE provider forum, and we will plan another one probably, I think, around March timeframe. I think that's when we did the last one, March, April, May. We will be definitely putting another one. So it's going to be about 6 months from now. And we will be sending a survey out after this to get your input around if anyone would be willing to do more of interactive of a session next time or not, or if you like the format the way it is, we can continue the way we've been doing. So just again, thank you. And we will also have this on and archived as well. So have a good day.
Thanks, everyone.
Thank you all. Stay safe and well.